Before any of this begins, there is a number. You worked it out at your own kitchen table, with no one selling you anything. Months of research behind it. It is the most honest number in this entire story, and it is the last one anybody will respect. Watch what happens to it. You think the dealership makes money selling cars. They don't. The car is not the product. The car is the bait. The real product is the financing, the add-ons, the doc fee, the gap insurance, the extended warranty sold in the finance office when you're already mentally driving home. In April 2026, the Federal Trade Commission and the Maryland Attorney General closed a case against Lindsay Automotive Group. The finding: for nearly 6 years, Lindsay advertised prices it had no intention of honoring, then charged buyers for add-ons they never agreed to. Between April 2020 and December 2025, the buyers caught up in this were charged more than $75 million. $75 million. Taken a few hundred at a time from people who could not tell you exactly where it went. This is not an accident. This is not one bad dealership. This is an architecture, a 4-layer profit machine engineered to exhaust you into accepting fees you never agreed to. And today, we are going to expose every layer. Then, I'm going to give you the exact counter playbook to walk into a dealership and walk out with your money intact. Here is the architecture, 4 layers, each designed to extract money before you realize what's happening. Layer 1, the advertised price. This is the bait. That number you see online, $35,000, $40,000, whatever it says, that price almost always includes incentives you do not qualify for. Military discount, recent college grad, loyalty bonus. The dealership stacks every possible rebate into that price. That is exactly what the FTC found at Lindsay. Buyers were told they couldn't have the advertised price because they didn't qualify for the rebates baked into it. By the time you find that out, you're already there. You've already test-driven the car, you're already emotionally attached, and that is exactly the point. We know how widespread this is because in March 2026, the FTC sent warning letters to 97 dealership groups across the country. The message was blunt. The price you advertise must be the total price, including every mandatory fee, not 97 dealerships, 97 groups, companies that own dealerships, sometimes dozens each. When a regulator has to write the same letter 97 times, it is not correcting a few bad dealerships. It is describing how the industry works. And before the price is settled, they will ask about the car you arrived in. The appraiser walks around it slowly, notes a scratch, checks a tire, writes down a number, and the number is lower than you expected. The money is not the point of this. The point is that a moment ago you were tracking one number. Now you are tracking 2. What the new car costs and what the old one is worth. And 2 numbers is all they need. Because the moment there is more than one, the difference can be moved between them. Ask for a better price, and you will see something strange. The salesperson does not say yes and does not say no. He picks up the sheet and walks it to another desk. A manager glances at it and gives back a number he was always going to give. The salesperson returns, having won something for you. He looks like he fought for it. That concession was approved before he stood up. The walk is not a negotiation. It is a product. What you are buying is the feeling that somebody is on your side. Layer 2, the add-on Gauntlet. Paint and fabric coatings, theft protection, VIN etching, tire and rim plans. These are the highest margin items on the lot, and we don't have to guess by how much, because in one case, the dealer group wrote it down. In December 2024, the FTC and the state of Illinois brought a case against Leader Automotive Group, 10 dealerships owned by the Canadian company Auto Canada. Inside that complaint are the company's own internal numbers. At one point, Leader's dealerships were reporting more than 99% profit on their add-on products. 99%. not margin on a product, vary nearly the entire price. It gets worse. A survey of Leader's customers found that nearly 80% of them were charged for at least one add-on they never authorized. Either it appeared without their knowledge or they were falsely told it was required. Salespeople were paid commission on these products and in many cases earned more from selling the add-on than from selling the car. And in some cases, according to the complaint, Leader charged customers for products it never actually installed. You paid for a coating that was never applied, a device that was never fitted. Here is the line you will hear on the lot. That's already on the vehicle. We can't remove it. Leader made that a policy requiring a paint coating on every new and used car it sold starting in 2021. That claim is a negotiating position, not a fact. The add-on is a sticker, a spray, or a valve cap. Its price can be moved to zero. Layer 3. The finance office. This is where the architecture becomes genuinely hostile. You have just spent 2 to 3 hours negotiating. You are mentally drained. You are already picturing yourself driving the car home. And then they put you in a small office with the finance manager. The finance manager is not a paperwork processor. The finance manager is a salesperson, and the product is money. Across the large publicly traded dealership groups, finance and insurance brings in about $2,500 of gross profit per vehicle sold. What makes that number matter is not its size. It is its stability. Profit on the car itself swings hard with the market. The finance office barely moves. It is the floor the whole business stands on. They present you with the monthly payment, not the total price. They offer you the extended warranty, the gap insurance, the tire and wheel package, the prepaid maintenance plan, all as just a few dollars more per month. But here is what they do not tell you. When you finance through the dealership, they send your application to a lender. The lender comes back with the lowest rate it will accept. That's called the buy rate. The dealer is then permitted to write your contract at a higher rate and keep most of the difference. You never see the buy rate. You are never told it exists. Researchers at MIT, the Federal Reserve Bank of Chicago, and the Consumer Financial Protection Bureau studied this using confidential lending records. Nearly 4 out of 5 loans are marked up. The typical markup adds just over 1% to your interest rate, $647 over the life of the loan. For the hardest hit, 10%, more than $1,600. Now, here is the finding that should change how you walk into a dealership. The researchers asked a harder question. Why does one buyer get marked up a full point and the next one not at all? They checked everything they could measure about those buyers. Almost nothing explained it, except one thing, what the buyer believed before they walked in. Buyers who agreed that all lenders offer roughly the same rate were marked up an extra 47 basis points. Buyers who believed dealers get you the best rates were marked up an extra 35. The markup is not priced to your credit. It is priced to your confidence. The dealership is not charging you for risk. It is charging you for not shopping around. Layer 4. The documentation fee. This is the quietest layer and, in some ways, the most infuriating. The doc fee is supposedly for processing your title, registration, and paperwork. In reality, it is dealer profit dressed up as a mandatory government charge. A minority of states cap it. Most do not. California caps it at $85. In Florida, there is no cap at all, and the typical charge is $999. Same paperwork, same few minutes of typing. $85 in one state, $1,000 in another. In 2025, California's car dealers asked the state for permission to charge more. They wanted this fee raised from $85 to $260. The governor said no. His written reason, a car buyer would be paying a dealership, quote, for only minutes of data entry. Let me show you what this architecture produces in the real world. Not anecdotes. Court records, Leader Automotive Group, 10 dealerships. The FTC and the state of Illinois found they deceived buyers about the price and availability of cars, charged for expensive add-ons without consent, tacked on junk fees, and posted fake reviews to protect their reputation. $20 million, the largest judgment the FTC has ever secured against an auto dealer. Lindsay Automotive Group. Falsely advertised low prices, then hundreds or thousands of dollars in charges appeared once you arrived. Buyers were also told they had to finance through the dealership to get the advertised price, including military buyers who already had a loan from their own credit union. $3.1 million in civil penalties and more than $75 million in charges on the record. 2 dealer groups. $23 million in judgments and penalties, and that is before you count what buyers actually lost. Now, here is what I want you to notice. In none of these cases did anyone force a signature. Every one of those buyers signed, willingly. And they signed at a very specific moment. Read the FTC's complaints, and the same detail appears in both. The charges went in at the end, after hours of negotiation, into contracts that can run 60 pages. Not because anyone was fooled by a clever argument, because it was hour 3, the paperwork was thick, the pen was already in their hand, and one more line item did not seem worth another fight. That is not a failure of intelligence. That is the architecture working exactly as designed. So why does this architecture exist? Why doesn't the dealership just list the real price and sell the car? Because margins on the car itself are volatile and shrinking. The money a dealership can actually count on comes from everywhere else. The finance office, the service bay, the used lot. The add-ons, the markup, the warranty, those are not extras. That is the business, and they will tell you so if you read their internal messages. The FTC's complaint against Leader quotes the company's vice president explaining what their low advertised prices were for: to get customers, quote, through the door. In another message to staff, the complaint alleges he wrote that once customers reach the store, quote, they're not leaving without buying a car. Now, you might reasonably ask why the government hasn't simply outlawed this. It tried. In December 2023, the FTC finalized something called the CARS rule. It would have required dealers to advertise the true total price, banned charging for add-ons that provide no benefit, and required your express written consent for every single charge. Layer 1 and Layer 2 eliminated by regulation. It was set to take effect on the 30th of July, 2024. It never did. The industry sued, and the FTC paused it. In January 2025, a federal appeals court threw the rule out, but not because the dealers were in the right. The court never looked at that question at all. It threw the rule out because the FTC had skipped a step while writing it, a notice that was supposed to be published first and never was. A paperwork error, in a rule about paperwork errors. The FTC did not appeal. On the 12th of February, 2026, it quietly removed the rule from the books. So the practices remain, and enforcement comes one dealer at a time, years after the money is gone, which means the only protection you can rely on is the one you bring with you. You cannot change the architecture, but you can walk through it without getting trapped. 4 steps. Step 1. The out-the-door price email. Before you enter a single dealership, email 3 to 5 dealers. Use this exact script. I am buying a specific car, year, make, model, trim. I am contacting multiple dealers. Please send me your best out-the-door price, including all taxes, fees, and add-ons. I will buy from whoever gives me the best number. Do not negotiate in their building. Do not negotiate over the phone. Negotiate in writing, on your screen, on your time. This single move reverses the power dynamic. You are no longer a customer on their lot. You are a buyer collecting bids. Step 2. The 4-square defense. When you sit down with the salesperson, they will likely use a 4-square worksheet: trade-in value, purchase price, down payment, monthly payment. The worksheet is designed to confuse you. The dealer moves numbers between the squares, lowering the monthly payment while raising the total price, inflating the trade-in while marking up the car. Your defense? Negotiate one number and one number only, the out-the-door price. Ignore the monthly payment entirely until the total is locked in writing, and get pre-approved through a credit union or your own bank before you go. Remember what the research found. The markup is priced to your confidence, not your credit. Walking in with your own approved rate is not just a better loan, it is proof that you shopped. When the dealer cannot touch your financing, that entire layer goes to zero. Step 3. The finance office script. When the finance manager begins their presentation, you say this: I am declining all additional products. I have pre-approved financing. I want to see only the numbers we agreed to. Then hold the line, because this is the moment the whole architecture was built for. You are tired, it is hour 3, and every product is about to be quoted to you in dollars per month. Gap Insurance shows you the spread most clearly. At the dealership, it typically runs $500 to $1,000 rolled into your loan, so you pay interest on it for 6 years. Added to your existing car insurance policy, it usually costs somewhere between $20 and $100 a year. Through a credit union, a few hundred once. Extended warranties can be bought later from third-party providers for significantly less. The tire and wheel package, the prepaid maintenance, the fabric protection, decline all of it. Every one of these products costs more in that room than it costs anywhere else on Earth. Step 4. The doc fee check. Before you go, look up your state's doc fee rules. If your state caps it and the dealer is charging more, they are breaking the law and you have immediate leverage. If your state has no cap, the doc fee is negotiable, even when the finance manager tells you it is not. Everything on the contract is negotiable. If they will not remove the fee, ask them to take the same amount off the price of the car instead. The number moves. It always moves. The car is not the product. The financing, the warranty, the coating on the paint, that's the product. The car is just the reason you walked in. A federal rule was written to stop this. It was killed on a technicality. Nobody is coming. So you go in knowing. One number, in writing, before you ever touch a steering wheel. Your own financing, approved before you arrive. They don't mark you up for who you are. They mark you up because you didn't think to check. Now, you will check. And that makes you the most dangerous person in the dealership. This is behind the spends. Decoding the systems behind spending.